Good morning. It's Jeffrey Christian of CPM Group. It's about 9:30 in the morning in New York on Friday, the 31st of March. It's the end of March. I wanted to talk today about the state of the economy and the state of the precious metals markets. Gold is trading around $2,000 right now. It got up to $2,005 earlier in the morning. It's testing 2,000. Silver has gotten as high as $24.20. It's around $24. It's trying to see if it can maintain $24. Platinum's off a little bit. Palladium's up a little bit. The dollar is flat. We wrote a piece recently called March Madness, and we talked about what's gone on in the gold market since over the course of March. And the price is up about almost $200 over the last several weeks. And a lot of that has to do, it reflects investor concern and financial market concerns about bank industry stability. It started with Silicon Valley Bank, spread to Sovereign and First Republic in the United States. Credit Suisse was taken over by UBS after its Arab supporters said that they didn't want to buy any more stock, and you had issues related to the equity balance of Credit Suisse. And in that kind of environment, gold has risen roughly $200, and silver has risen more than $2 an ounce. And we've been getting the question, is this the beginning of that financial crisis and recession that CPM Group has been talking about for several years, that we've been saying we thought could happen in 2024 or 2025, but it's really anybody's guess? And is this the beginning of that? And our answer is it's anybody's guess, but we look at the real economy where there's still slack in a number of industrial sectors' supply, and where consumer and business demand for goods and services remain very strong, where credit is high, and there are a lot of strengths still in the real economy. Fiscal policy is becoming more restrictive, but you could say it's less accommodating rather than more restrictive. So there's still a lot of oomph left in the economy. And the financial balances of the banking industry, which has really stimulated the most recent wave of fear, is actually mixed. Delinquencies are down sharply. There is a historically large mismatch between the maturity of their assets and liabilities, but these things can be managed, especially if the banks have risk managers and CFOs who understand what their roles are at the banks, which was something that was lacking at Silicon Valley Bank. And again, I will remind everybody, Silicon Valley Bank was a state-chartered bank, not a federally chartered bank. It was a member of the Federal Reserve Board network of banks, but the regulation and oversight resided in the state level, not the federal level, which allowed for sloppiness to emerge. But we compared March 2023 to March of 2008 and March of 2000. In March of 2000, the dot-com bubble, which had pumped up stock prices, and we had the new economic paradigm where we'd never have recessions or inflation again, and the Dow Jones would be 40,000 on an index basis in a very short time. That bubble started to pop in March of 2000. It didn't really become a problem that other broader people noticed and that threw us into a recession until March of 2001. So it was, as I've said repeatedly over the course of March, it was the foothills of that problem. In March of 2008, on Sunday, March 16th, 2008 to be exact, I know because I was in Cape Town, and the price, Bear Stearns basically rolled over, and the Fed engineered a takeover of Bear Stearns by J.P. Morgan, giving J.P. Morgan various federal assurances that it would help support J.P. Morgan by taking over Bear Stearns. And again, a very key difference, J.P. Morgan was a commercial bank regulated by the Fed and the Treasury and the OCC, and Bear Stearns was an investment bank, not regulated by those entities. The price of gold started 2008 around $750, $760. It broke over $1,000 for the first time on Monday, March 17th. CPM Group said to its clients, we had been telling people to buy gold from November of 2000 into March of 2008, we said, stand down, don't buy at prices over 1,000, wait for the price of gold to go down to 900 or lower. We think that will happen within a couple months. If you have the capacity, buy puts at $900, use July or August puts on the COMEX to give yourself several months, but we think that the price will deflate. The price got down to $904 by that Friday, and on April 1st, the price was below $900 and stayed below that. Those investors, and then we had said, start buying again when you see the price below $900. So our investors started buying again. Those people who had bought puts at when the price was $1,000 made a nice little profit on the puts, which reduced their net effective acquisition price by perhaps around $100 an ounce. Our view at that time was March and the Bear Stearns bankruptcy was not the end. It was the foothills of something bigger to come. And it was. We had relative calm in the financial markets then from late March into September. By September, things had gotten worse. Lehman went bust. The Fed let it go bust. It was broken up and sold off to competitors and other financial institutions. And we entered a much worse and more difficult financial period. Now, in late March, Doug Casey was having what he called Doug Casey's Crisis and Opportunity Conference in, I'm not sure if it was in Phoenix or if it was in Scottsdale, Arizona. And he asked me to come out there and give an institutional view of what was going on. And it was very interesting because, you know, the audience were basically self-made millionaires. They were wealthy people who had really built their own wealth. They were first-generation wealthy people, and they were basically frightened of losing what they had made. And at the time, you know, the big thing was that Hillary was going to make us all use unisexual bathrooms, and gay marriage was another trope that was being put out to cause people to be afraid. And there were real reasons to be afraid. We had invaded Afghanistan, we had invaded Iraq. The world was really saying, gee, the United States ought not to be the hegemon that it is. You had seen the dollar fall from the early 2002 into 2006, 2007 or so. Interest rates were rising. Economic problems were there. Oil prices had risen from $10 a barrel at the beginning of the decade to around $100 a barrel, going on to a spike of 140 later that year. There were a lot of reasons to be worried. And at Doug Casey's Crisis and Opportunity Conference, I made the joke when I gave my talk, which was titled Shocking Realities. All the other speakers were talking about the crisis. They were waving their arms and talking about, you know, everything to be afraid of, and you got to buy gold. And I got up and I said, okay, I'm the opportunity part. I'm going to talk about the opportunities that are presenting themselves because some of the inflation in asset values has come out, and now there are starting to be opportunities to make good and intelligent investments. At the end of the conference, there was a panel of speakers, and that is where the title, Is This the End, comes from. One of the questions for this panel of speakers, and remember, I'm the odd man out. I'm the the institutional representative, as Doug called it, me. One of the questions was, is this the end? And they went down this panel of pundits. They're not experts by any means. You know, gold bugs, people who had spent their entire careers trying to cause people to buy gold and silver out of fear. Fear of what's different, fear of what's not known, fear that the government's going to come and take your money away. And they went down this panel and they said, yes, this is the end. 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 And they got to me at the end of the table and I said, the end of what? You know, the world goes on, humanity goes on, lives end, movies end, books end, but this isn't a book or a movie, and it's much bigger than an individual's life. What is this the end of? And if you want me to say whether I think it's the end or not, let's define what the end is. So let's go through the panel again and say, if this is the end, what is it the end of? And what does tomorrow look like? And they went through the panel again, and none of them could describe or define what it was the end of. A couple of them said stuff like, I don't know what tomorrow will bring, but I'll be okay because I own gold. James Turk was next to me, and he was the only one who had a substantive response as to what is it the end of and what will tomorrow bring. And James said, it's the end of the financial system, and we're going to have to nationalize one or two banks the way the UK government has nationalized Northern Rock earlier in 2008. It comes back to me, and I said, that's it? You know, a couple banks are going to be nationalized? You have missed the two biggest bull markets in stocks and the two biggest bond market bull markets in history because you're waiting for the end, and in the end, a couple banks will be nationalized, which will be completely opaque to the users of those banks, much less opaque if they're not nationalized. Ask the guys who had their money at Lehman or Bear Stearns. That's the end. It was just amazing, you know, and that's where we are today. We're in the foothills of a cyclical economic cycle that is moving toward maturity and will probably go into a recession some point in the next 12 to 24 months. We will then come out of that recession, as we always do. We have a global and domestic financial crises that are coming up, but they will be dealt with. They will be problematic. People will lose a lot of money. People who have tried to hedge themselves in cryptos have already lost more than 2/3 of their value. At the beginning of 2022, the crypto market had a nominal market capitalization of $3 trillion. By the end of 2022, it was below $900 billion. 2/3 of the value of cryptos had been wiped out because of a lack of trust in a trustless environment. So that's not the end. We are in the foothills of those kinds of problems. CPM Group expects them to be papered over. I will talk about our market outlook in a couple minutes. But before I do that, I wanted to show you this. I got an email from one of the gold sales groups that, you know, they try to sell gold based on fine. Here's a list of our recent YouTube videos in which we interview various people. And here are the titles. Another bad year for the markets. The Fed can't fix this. Bull markets will lose. Global meltdown by 2025. The bullish data is, she said it, not me, bullshit. New era of scarcity. Clueless Fed, deep recession. The market's going to drop 50%. Dangerous stocks will drop by 50%. World trade breaking in half. A supply shocks ahead. The Fed has ruined home prices. I mean, just look at this stuff. You know, it's enough to make you want to go to the bathroom. And the thing is that with the exception of one of the people this company interviewed in any of these videos, they have been consistently wrong throughout their careers. One of the people they interviewed has had a good track record calling overall macroeconomic conditions, if not gold prices. One of them we respect. Out of all of those people they interviewed, those people will tell you this is the end. CPM Group's not going to tell you it's the end. Now, I thought about going through some charts and tables on banking. You can show you some problems in the banking industry. Again, as I said, that mismatch of maturities between assets and liabilities that has built up, that some banks, a lot of banks actually, have not handled particularly well. And I will say this, it looks bad. It probably looks worse than it is if you just look at the mismatch of maturities and the assets and liabilities. But if you take into account risk management programs that may have been put in place that don't show up in that balance sheet, it may be far less scary and worrisome and problematic than it looks like on the surface. We don't know, and we haven't done that work. I also was thinking about showing you some charts like commercial and residential delinquency rates at various banks on loans, which are at very low levels. They're much lower than they were for most of the last 20 or 30 years. So there's signs of strength and there's signs of weakness, and I said to myself, I don't want to nitpick and pick data that shows this and data that shows that, because then somebody else is going to nitpick me and say, well, you didn't show this or that. So I'm not going to do that. Instead, I'm going to talk about where the markets are and where we think they're going to go. As I said, gold prices are up about $200 since the end of February. That's a lot. They're up even more since the beginning of November. The beginning of November, they were $1,624. Today, they're $2,000. That's almost $400 higher. They're back up close to their highest levels ever on an intraday basis. Silver prices have done not quite so well. They have risen from about $20 at the end of February to $24. That's $4. That's, if you do the math, 20% increase in 1 month. They're up close to that was the ceiling in late December, early January, which saw the price fall back to $20. And they are up from about $17, $16 in late October, September, October, November. So the gold and silver prices have risen. They've risen because of investment demand. And investment demand has been driven by a number of things. Inflation fears, political fears, concerns about the dollar. The dollar has been weak throughout the last several months, and that has caused some shift into gold and silver on the part of investors. Concerns about the banking stability obviously have had a major effect over the course of March. And seasonal patterns of investment and fabrication demand have also been there, although the actual events, these are event-driven bull markets right now. Now, our expectation is that the economy is going to continue to be relatively good, around 2% real GDP in the second quarter and in the third quarter, and that the banking crises will be largely contained by banking regulators and by banking management, and that we will probably see gold and silver prices continue to trade, gold, let's say a low of 1720, 1740, and a high of 2000, 2060 is I think what we said earlier in the week. And silver, yes, you could see it come back to 20. I'm not sure that it goes below 20, but yeah, you could see it down to 18. I don't think it goes down to 16. And we could see it as high as 28 or 30, but not necessarily much higher for the next 6 months or so. Once we get into late 2023 and early 2024, we think the economic and political and financial market environments will change the same way they changed in the last 4 months of 2008. Maybe not exactly the same way, but we think that you'll see a replay of 2008 in terms of the underlying economic and political environment and the effects on gold and silver investment demand and prices. So we're looking for a period in which investors can say, I'm not going to buy gold at $2,000 and I'm not going to buy gold at $24. I might buy puts, but what I really am going to be doing is I'm going to be looking to accumulate gold if the gold price falls back to 1,800 or so, and if the silver price falls back to 20 or 21. Those might be good prices to buy gold and silver from an intermediate and long-term perspective. But I'm not going to chase the price higher the way other investors are doing. Another trend which we've seen, which continues, is a flight to quality and safety. You're seeing that across financial markets, and you're seeing it in the gold and silver markets. So any number of investors are saying, I continue to want to own gold and silver in ETF form, but I want to own the most liquid and largest and respected and financially secure ETFs, and not ones from smaller banks that may not be as financially stable and secure as the big banks that run the big ones. So you're seeing some investors shift out of smaller ETFs into bigger ETFs, and then you're seeing probably a greater number of investors saying, I want physical gold and silver, not a share of an offshore company that owns gold and silver. That for the most part, yes, there are a couple ETFs that you can turn in your ETF shares for physical metal, but for the most part, ETFs don't really make that easy. And even with those ETFs that allow you to sell your shares for gold or silver, you have to look at the transaction cost there compared to just simply saying, let me sell these shares and then buy some gold and silver. You have to be a comparison shopper. That's about all I have now. I've gone longer than I wanted to. You can go to our website and read about us and download things, and you can buy some of our research and consulting services. You can go to YouTube and see past videos. We did launch our Gold Yearbook on Tuesday of this week. There is an hour-and-a-half briefing available on YouTube that you can watch our overview of the gold market, supply, demand, price, last year and our expectations for this year going forward. We have a big discussion about central banks, and about half hour of the 90 minutes is questions and answers from the audience. We will be doing an open forum for our clients, including our retail investment clients, next Monday. You can go to our website, and if you are a client, you can register to participate in that online open forum. Just a question and answer. We already have about 5 or 6 questions that people have emailed to us and said, please address these issues in the open forum next Monday. And we will. Have a good weekend. Take care of yourself and those around you. Take care of the world insofar as you can. And read on.